solution that fits for those clients that don't need all of their assets to support their lifestyle. So we're talking about enhancing multi-generational portfolios with permanent insurance. Another way to think of this is how insurance complements a leave-on, in air quotes, portfolio. So what do I mean by a leave-on portfolio? It means the client's got a multi-generational perspective that they're not going to need those assets to support their lifestyle. They're not going to consume all their assets. So since they have more than enough to support their lifestyle through retirement, they can allocate a portion of that portfolio to life insurance. And in this case, we're talking about a portion of the fixed allocation, including permanent life insurance. In most cases, it's 1, maybe as much as 2% of the overall portfolio growth allocated to life insurance. You do not need to invade the principal at all. So why does this work? You treat each premium like it's an investment in the contract, and you treat the proceeds like it's a return on your investment. So that makes sense, but there's an unknown factor with life insurance. It's tied to mortality, so you don't know when the investment pays off. The best way to do this is you view that payoff as occurring in a range of years based on reasonable assumptions, generally speaking, life expectancy of the client. At life expectancy, the return is going to outperform the rest of the fixed bucket and maybe the entire portfolio. So portfolio only has cash, equities, a fixed bucket, and alternatives. In this case, we're talking about adding life insurance to this fixed portfolio. And again, only 1% maybe of the entire portfolio value on an annual basis, not dipping into the actual principal at all. The proceeds are going to return 6 to 10% income tax free when the client's in their mid to late 80s. Considering a 40% bracket, the tax equivalent yield on, let's say, an 8% return would be 13 1/3. Well, that type of rate of return is going to enhance almost any portfolio, especially if you look at the return profile on the fixed bucket. So let's fire through a couple examples. Let's assume, and I'm setting aside all estate tax planning, the focus here is the portfolio. Obviously, in this case, if the client's got $10 million of AUM, they probably have other assets, and we need to be doing estate tax planning. That's not the focus of today's presentation. I just want to go through the portfolio aspects. Here, it's a second to die on a young couple, 56, 57. They've got $10 million that they're not going to need to support their lifestyle. And we're assuming net of taxes, net of fees, 4.5% rate of return. If you do that $10 million, that's the gray line. What we're going to do is take a small portion of the portfolio, 1.1%, and buy a $15 million policy. They're young and healthy. At age 99, the portfolio will outperform the portfolio plus insurance, because every dollar you commit into your life insurance policy that you allocate to a policy is a dollar that's not compounding in the estate. So eventually, in every case, there's a crossover point. Based on these assumptions, that's age 99 for this couple. What happens at age 87, around their joint life expectancy? Well, their heirs, their legacy is greater by $7.3 million if you include the insurance in their portfolio. The tax-free internal rate of return on that policy is 8.64%. The tax equivalent yield, assuming 40% bracket, is 14%. The family is significantly better off all the way through, and net life expectancy is 17% improvement. Let's take the other end of the spectrum. This client, again, we're using a second to die policy, also young, age 61. This client has got a smaller portfolio, $3.4 million, not even 3.3 and change. They don't need this money to support their lifestyle. This is earmarked for their kids and grandkids. They've got that multi-generational perspective. No estate tax issues here. Just it's a leave on versus live on question. Live on is covered. So if we take about 1% of the portfolio and allocate that to insurance, we can essentially double the portfolio. So you have the gray line, which is the portfolio only. Green line is portfolio plus insurance. Crossover point's age 97. At 87, the heirs, the legacy is improved by more than $1.5 million. The tax-free rate of returns, 8.5%. Assuming a 40% bracket, the tax equivalent yields 14%. And guess what? The family's 14% better off. So what if you take a single life and you assume that the portfolio, the assumed interest rate is much higher? So in this example, we've got a single female, age 64. We've got a $3 million leave-on portfolio with an assumed interest rate of 6%. So this is somebody in their 60s, 70s, 80s, et cetera. We're assuming 6% net of fees, net of taxes every year. So pretty aggressive portfolio. If we take 1.6% of this portfolio and we commit it to life insurance, essentially double the size of the portfolio, what happens? Well, at age 90, you hit the crossover point, and that's because the rate of return you're assuming on the AUM. So then that leaves open a question: which triangle, for all intents and purposes, that one or that one, represents the greater financial risk, right? What would cost more from a financial perspective? Predeceasing, at a young age, or experiencing extreme longevity? Well, obviously, it's the mortality risk. But the real story here is that even if her portfolio were to get something even better than 6%, the life insurance policy doesn't need to outperform the entire portfolio. It only needs to outperform the fixed allocation. So at 85, what do we have here? We have an 8.4% tax-free rate of return. That's 14% if it were taxable at a 40% bracket. So as long as the portfolio, as long as the insurance can get these types of returns, and it should and will, then it makes sense as an allocation within the fixed bucket, even if someone's getting high rates of return. 14 is going to outperform much, it's going to enhance the overall portfolio. So again, just to quickly recap, the only difference between a leave-on portfolio, the only difference is going to be that life insurance, you're using 1% of maybe of the portfolio on an annual basis, and life insurance is going to be in the fixed portfolio. We have a customized 2-pager to, it's for proof of concept. We can brand it for your firm if you'd like. All the basic assumptions you provide. We lay out the math, including the net improvement and where that crossover point occurs. And then we highlight that crossover point, so the client, we make sure they're comfortable getting into this, because you're moving from a liquid to an illiquid position, right? And that's why this is ideal for clients with a multi-generational kind of leave-on perspective. We provide when that crossover, or what the internal rate of return is in the late 80s at age 87, and from that point, the math is the math, and if the math provides an enhancement, let's continue the conversation. So who are the candidates for this? Live on is satisfied. So if the clients need their assets to support their lifestyle, they're not a fit. Leave on is the goal. They've got a multi-generational wealth transfer mentality, and they're in good health under the age of 80. On the front end, we can provide all the case consultation you need, including that client deliverable. We can join the conversation with you and your client's other professional advisors and the client if you want. And on the back end, we'll help you with everything from licensing, contracting, application support, getting that policy delivered, and monitoring policy performance. We want to connect with you. We want to work with you and share our story and see if we can help you or any of your clients with their wealth transfer needs. With that, thank you very much. Have a great day.